COMEX silver is about to hit a moment where a whole lot of people are asking, okay, so where's the actual metal? And the numbers on the public screens don't look like they're answering that question fast enough. I wasn't going to make this video. I'm literally standing here with my jacket half zipped, coffee in one hand, phone in the other, thinking, do I really want to go down this rabbit hole today? Then I saw the latest delivery and inventory updates, and I thought, nah, you deserve to see this laid out clean. It's Friday, February 6th, New York time. Comment what day and date you're watching from, because half of you binge these videos 3 weeks later, and I love you for it. Also, quick announcement. I'm running a campaign to eliminate copycat channels. If you value what I do here, support me by subscribing and drop your Mick AG in the comments. That helps more than you think. Now, the mainstream take on silver is always the same. It's either nothing to see here or silver is volatile, end of story. And then they move on. But when you zoom in on the plumbing, deliveries, open interest, what's actually registered for delivery, things start to look weird. Not aliens built the pyramids weird, just the math is getting tight weird. And look, I get it. Talking about silver delivery data sounds like watching paint dry while someone reads you a shipping manifest. But the reason I'm leaning in today is simple. The most interesting stuff in markets is almost always hiding in the boring paperwork. Prices are the loud part. Inventory categories are the quiet part. And when the quiet part starts screaming, you want to be listening. Yes, I'm aware how insane that sentence sounds. Here's the next key date, because this is not some vague, sometime in the future story. We're roughly a few weeks away from the first notice window for the March contract. Think late February, around February 27th, when the market starts separating the people who want to trade paper from the people who want to be paid in metal. That's the moment this stops being a debate on social media and becomes a logistics problem. So when I say tight, I mean tight on a calendar. And that's why I'm reordering this video the way I am. I'm starting with the stress point. Then I'm going to rewind and show you how we got here, because otherwise it all sounds like doom posting. Okay, good. I'm going to do this in a way that's actually useful. I'm going to break down 3 things. First, what's been happening with deliveries over the last year compared with the year before? Because the change is broad, not a 1-month fluke. Second, why the last couple of months are the part you should actually care about, because the behavior suddenly looks like people want metal now, not later. And third, what the next big delivery window could look like if even a modest slice of those contracts stops playing paper games and starts saying, ship it. Okay, big picture. Before we even touch March, I want you to absorb one idea. Last year wasn't a normal delivery year. If you take the total ounces delivered across the whole year and compare it with the year before, you're not looking at a gentle rise. You're looking at something like 200 million-ish, turning into approaching 500 million-ish. That's the kind of change you feel in the system because it isn't a rounding error. It's a different regime. And here's what really matters. That jump didn't come from a single freak month. It came from basically everywhere. Even months that usually act like background noise suddenly started printing real delivery numbers. That's why I'm not letting anybody wave this away with, oh, it's just one delivery month. No, the behavior change is persistent. And to be fair, there are a few benign explanations. Sometimes large commercial players change their hedging policies. Sometimes more metal flows through the exchange because it's convenient financing. Sometimes people want warehouse receipts, not bars, because that's useful collateral in other parts of the market. Those are real possibilities, but then you look at the recent months and the benign explanations start feeling incomplete. From recently published exchange delivery tallies, the total amount of silver that actually went through delivery last year wasn't just up a little bit, it was up massively. Think well over double compared with the year before. And the part that matters is not the headline total. The part that matters is the pattern. Month after month, the delivery calls were higher than the same months a year earlier. That's not how a sleepy, well-balanced futures market usually behaves. Usually, most people use futures to manage price exposure. They roll, they net, they offset, they close, they settle financially. Physical delivery is there as a feature in the background, like the emergency exit on a plane. You know it exists, but most passengers are not trying to open it mid-flight. Last year, a lot more passengers reached for the handle. And if you've never watched this process up close, here's the quick version in human language. A futures contract is basically a promise with a calendar attached. Most traders treat it like a price bet. They never want a truck, they never want a pallet. They just want the price exposure, and they want to be out before delivery. But the contract has a delivery mechanism sitting underneath it like a loaded spring. When the notice period approaches, somebody has to either step away, roll the position to a later month, or stand and take delivery. Rolling is the normal move. You close the nearby month and you open the next one. It's like switching seats on the same train so you don't have to get off at the station. Standing for delivery is the serious move. That's when the contract turns into an obligation. Metal has to be assigned, warehouse receipts change hands, the system has to find deliverable supply. And the reason open interest matters is not because it equals demand, it's because it's the pool of potential demand. It's the crowd outside the venue. Most people won't go in. But if the venue is small, you don't need most. You need enough. That's why I keep saying even a modest share standing can create stress when the underlying registered inventory is trending down. Okay, now that you're oriented, let's keep going. And it wasn't just the big delivery months doing the heavy lifting, it was basically the whole calendar. That's the tell. When every month looks heavier than the prior year, something's changing in how participants are using the system. Now let's zoom in, because this is where it gets spicy. January is normally not the month where everybody loses their mind. It's not supposed to be the main event. Yet this January, deliveries came in at a level that looks more like a headline month. We're not talking a slight bump, we're talking many multiples above what January looked like a couple of years ago. And that matters because it suggests urgency. When people rush delivery forward into a quieter month, one explanation is simple. They'd rather take metal now than risk competing for it later. It's the financial version of showing up early to the airport because you've been burned by that one gate agent who closes boarding on time. And if you want the scale of the change without getting lost in decimals, think of it like this. A couple of years back, January deliveries were in that single-digit million zone. Then last year, January stepped up into the low double-digit zone. And this year, January printed something closer to around 50 million in a month that's not supposed to be the headline act. That kind of ramp is not subtle. It tells you something about preference. Preference for certainty, preference for possession, preference for not trusting the system to be generous later. And again, I'm not saying every ounce delivered in January was someone panicking. Sometimes it's just smart logistics. Sometimes it's just arbitrage. Sometimes it's a big player tidying up inventory before quarter-end style reporting. But when the same urgency shows up immediately in February, you have to at least entertain the idea that this is a crowd behavior shift, not a single player's housekeeping. Could it be something else? Sure, it could be hedgers rearranging positions, it could be a one-off, it could be a big player doing something mechanical, but when you line it up with what happened next, it starts to look less like a coincidence and more like a trend. Because February hit, and the first handful of days of February basically acted like the whole month. Think about that, just a few days in, and deliveries were already near last year's full month level for February. That's not normal rhythm. That's everybody's trying to get their seat before the music stops, rhythm. And the open interest context makes it even more intense. As of the earlier snapshot in January, the open interest for the February contract, measured in ounces, was roughly around 20 million. And within the first few days of February, deliveries were already chewing through almost all of that. Not half, not a third, almost all. That is not how a typical futures month behaves. In a normal month, only a small slice stands for delivery. Low single digits is common. Mid-single digits is still normal. In a stressed month, you might see something like low double digits, maybe a bit higher. But when it starts to look like nearly everyone is standing, that's not a futures contract ecosystem anymore. That's basically a queue at a warehouse door. And to appreciate how extreme that is, imagine you run a restaurant where people normally reserve tables, but only a few actually show up. You staff for the few. You don't staff for everyone, because that would be insane and expensive. A futures market is similar. It's built on the assumption that only a slice stands for delivery. The whole machine, margining, warehousing, assignments, works smoothly because delivery demand is usually a minority. When delivery demand starts looking like the majority, the system can still function, but it stops feeling like a futures market and starts feeling like rationing. And that's why people who never cared about delivery suddenly care, not because they're metal nerds, because it's a confidence indicator. If you think you're going to get metal, you trade calmly. If you think you might not, you either demand it early, or you demand it aggressively, or you demand compensation to roll. Those are the three common reactions. And February, at least on the surface, looked like the demanded aggressively phase. Now here's where we need to be careful, because I can already hear the comments. John, open interest changes every day. People roll, people close, the numbers move. Yes, all true. But the point isn't that the numbers are perfectly frozen. The point is the intensity. Even if the open interest wiggles, the delivery pace in the first days of February was so heavy that it signals a mindset shift. People are not casually trading paper. They're leaning into physical settlement. Which brings us to the real cliffhanger. March. March is one of the big ones. It's the month where, historically, you actually expect heavier delivery activity. And as of the latest publicly available market updates, the open interest tied to March, again measured in ounces, was sitting at a little over 400 million ounces. Let that sink in. A little over 400 million ounces of paper claims pointing at a delivery month. And what's fascinating is how that number got there. Earlier in January, a chunk of positioning was sitting in March, and then you watch it migrate. Some of it rolls forward into May as the calendar turns. Some of it gets closed out. And based on the way January delivery spiked, it's reasonable to suspect some players didn't just roll forward. They pulled the delivery forward. They effectively said, "Don't make me wait for March. Give it to me now." That's not the default behavior in a paper-first market. It's also why you can't just look at March in isolation. March is the stage, but the cast has been rehearsing in January and February. And when you see May open interest building at the same time, that's the market telling you. Even if March cools off, the story continues. So we're not watching a single event. We're watching a migration of pressure across the curve. Now, no, that does not mean 400 million ounces will be demanded. That's not how it works. Most of it typically rolls or gets closed. But here's the problem. You don't need anywhere near all of it to stand for delivery to create stress. If even about a quarter stands, you're talking north of 100 million ounces wanting to show up at the door. If around half stands, now you're talking a couple 100 million ounces. And if we get into a scenario where the majority stands, it gets truly ugly, truly fast. Now let's talk supply, because this is the part people ignore until the day it matters. COMEX warehouses track categories. The category that actually matters for delivery is registered. Registered is the bucket that is supposed to be immediately deliverable against futures contracts. Eligible is stored metal that belongs to someone sitting in an approved facility but not pledged for delivery unless the owner decides to make it so. And from the recent inventory updates, registered silver has been sliding. Not drifting, sliding. Go back a few months, and registered was sitting somewhere around 170 million ounces. Then you get into early January, and it's closer to the low 100s. Then later in January, it steps down again. And now, in the latest snapshot, it's hovering just above 100 million. That is not a gentle leak. That's a drain. And the timing is what makes it feel urgent, because the countdown to March is not long. If we're heading into first notice around February 27th, we don't have plenty of time for the inventory story to reverse itself. We have a handful of weeks. So when I see the recent pace, again, roughly 750,000 ounces a day shifting out of registered, I can't unsee the implication. You don't need a perfect projection. You just need to recognize the direction and the speed. Direction, down, speed, fast. And yes, speed can change, drains can slow, metal can reclassify, but the burden of proof shifts when you've had multiple weeks of the same trend. Over just a few months, registered went from around the high 170 millions of ounces down to just over 100 million. That's a huge drop in a very short period, close to a 40% decline in that delivery-ready bucket. And it didn't slow down. If anything, the drain got faster in the most recent stretch. Think something like 750,000 ounces leaving registered per day on average over the latest window. If that pace even roughly continues into the start of the March delivery period, late February, you're talking about registered potentially landing in the mid-80s of millions of ounces when the March notice window kicks off. So now we've got a setup. Potential demand, even at conservative delivery rates, can start pushing into the same neighborhood as the registered supply. And remember, last year's March deliveries were big. If we simply repeat something like that, the system gets tight even before we start modeling higher participation. This is why people are watching this like hawks, because the moment you get a delivery month where the demanded ounces are meaningfully above what's sitting in registered, the exchange has to solve that gap somehow. And here's the part where I'm going to push back just a little against the doom narrative. A lot of folks hear registered as low and immediately jump to default tomorrow. That's not automatically true. First, registered can change. Metal can move from eligible into registered if owners choose. Metal can also be brought in from outside the system. And futures markets have pressure release valves. People can be incentivized to roll. Spread premiums can widen. Cash can tempt people to settle financially. And the system can survive longer than you think. So I'm not here to tell you this is guaranteed to explode. I'm here to tell you the setup is unusually tight, and that changes behavior. Now, about eligible. There is a lot of eligible silver sitting in approved warehouses, something like just under 300 million ounces in the latest snapshot. So the obvious question is, why not just convert it and solve the problem? And the answer is because eligible is owned. That's someone's metal. Maybe it's an investment vehicle, maybe it's a private holder, maybe it's a commercial operator, maybe it's a big institution. Whoever it is, the metal is in storage for their reasons, not because the market needs it. To convert eligible into registered, the owner has to raise their hand and say, "Yeah, go ahead, make my metal available for delivery." And if owners believe the market is moving into a squeeze-like dynamic where availability tightens and price responses get violent, why would they volunteer their metal at today's terms? If you think the price is going to be higher tomorrow, you don't put your house on the market today, unless you're forced. So eligible is not a magic emergency stash. It's potential supply, but it's optional supply. And optional supply behaves differently when everyone gets nervous. Now let's pull this back into a storyline you can actually track. We have a year where deliveries surged broadly, not a blip, broadly. We have a January that acted like it didn't want to wait for March. We have a February that, right out of the gate, started chewing through nearly the entire delivery interest base. We have a March sitting there with a pile of open interest that is enormous in ounce terms. And we have registered inventory trending down hard at the same time. That combination is why people are even using the phrase crunch. Now, what could happen next? Scenario 1. The market behaves normally or close to normal. Most March contracts roll forward. A manageable amount stands. Deliveries land in a range that the system can handle because registered stays high enough, and maybe a bit of eligible converts. In that world, March is tense, but it passes. But, and this is the part people miss, that doesn't magically remove the pressure. It just pushes it forward because the next major month starts getting heavier. You can already see open interest migrating and building in later contracts. Think May getting bigger as March shrinks. That's not automatically bullish or bearish. It's just how the machine rolls. But it does mean the question doesn't disappear. It relocates. And you can see hints of that in the rest of the curve. Later months already carry meaningful open interest, even if it's smaller than March or May. Summer has a stack. Early fall has a stack. And by the time you get to the big year-end month again, there's still a pile of paper claims sitting there waiting for their turn. That matters because inventory drains don't politely stop after one delivery month. If metal is leaving the registered bucket month after month, the system doesn't get a reset button, it gets a treadmill. So even in the March is fine world, you still have to ask, what does fine look like in May? And what does fine look like after that? Now, if you're new to this, that can sound dramatic, but it's actually just a risk management question. Where is pressure accumulating, and how fast is the pressure traveling? And for the record, pressure traveling is a real thing. It shows up when open interest doesn't disappear. It just slides forward. It's like pushing clutter from one room to the next and calling the house clean. Eventually, you run out of rooms. Scenario 2, we get a higher than usual share standing for delivery in March. Not everyone, but enough that registered looks thin. In that world, you may see aggressive incentives to roll. You may see spreads do strange things. You may see a lot more talk about alternative settlement. Scenario 3. The system faces a moment where requested delivery meaningfully exceeds what is sitting in registered and willing to convert eligible. In that world, the exchange has to protect itself. That could mean cash settlement pressure, rule interpretations, delays, or simply a confidence shock that changes how people view paper pricing. And if you've never thought about cash settlement in a metal market, let me translate why people react emotionally to that phrase. A futures contract is marketed as a standardized promise. If I hold the long side into delivery, I have the right to receive the underlying commodity, not just an apology letter and a check. So when the market starts whispering about maybe you'll get cash instead, even if it's technically voluntary, it changes incentives. It turns delivery into a negotiation. Some people will take cash happily, others will refuse on principle, and the ones who refuse are often the ones who care about physical supply the most. That's when you can get a feedback loop. Fear of scarcity creates more delivery demand, which creates more stress, which creates more fear. It's not magic. It's human behavior. And it's also where I want you to stay skeptical, because there's another possibility that doesn't get enough airtime. Sometimes the market does this because it can. Sometimes big players deliberately pressure nearby delivery months to extract better roll terms. They're not trying to break anything. They're trying to get paid to move. They stand, they threaten to stand, they make the short side nervous, and then they accept a rich roll into the next month. That is a very real strategy in commodity markets. So when you see high delivery interest and tight registered inventory, the question is not just, is the system failing? The question is also, who benefits from making it look like it might fail? That's the skeptical lens I want you to keep in your pocket, because the same data can support two stories: a genuine shortage story, or a leverage and negotiation story. And sometimes it's both at once. And here's the key. Even if a technical default never happens, confidence can crack without it. Markets run on belief. The moment enough participants think the paper claim isn't equal to the metal claim, behavior shifts. And that's when you get nonlinear moves. So what do you do with this information? First, don't let anyone talk you into certainty. If someone is screaming guaranteed collapse or guaranteed nothing, they're selling you emotion, not analysis. Second, watch the boring stuff. The daily warehouse updates, the registered trend, the pace of movement, the spread behavior between nearby months, the way open interest migrates as notice approaches. That's where you see stress building before the headlines catch up. Third, zoom out and remember why silver markets get fragile in the first place. Silver is not just a shiny thing people like. It's a working metal. It sits inside electronics, energy systems, medical applications, and a lot of industrial supply chains. When industrial demand is steady and investment demand wakes up at the same time, inventories don't have infinite elasticity. The supply pipeline moves slower than the price chart. That's not a prediction. That's just how commodities behave. And fourth, this is important. Be honest about what you're trying to accomplish. Are you trading a move? Are you investing for a longer cycle? Are you hedging something else? Those are different games, and the wrong game will make you miserable. Now let me ask you two questions because I want to see where your head is at. Do you think March becomes the pressure point, or does the market kick the can into May and make that the real showdown? And second, do you think eligible owners will actually volunteer metal if spreads get wild, or do you think they'll sit tight and let the system sweat? Drop your thoughts below. Also, if you've got access to real-world premiums where you live, coin shops, wholesale quotes, whatever, tell us what you're seeing. Are premiums calm, or are they creeping? That's often the first place stress shows up, long before the futures chart reacts. Keep it general, no personal info, just the vibe. I'll read as many as I can, and it helps everybody compare notes without guessing too. And if you're successful, seriously, share your success story in the comments so others can stay motivated. I love seeing that, and other people need it more than they'll admit. Also, if this kind of breakdown helps you think more clearly, subscribe. And remember, if you want to support the campaign against copycats, comment your Mick AG. It signals to the algorithm that the real community is here. Before I go, here are the 3 simple signals I'm personally watching, because they cut through the noise. Number 1, does registered stabilize for a few consecutive updates, or does it keep stair-stepping lower? Stabilization changes the tone. Continuous drawdowns keep the pressure alive. Number 2, what happens to the roll cost between March and May as we approach first notice? If the roll gets unusually expensive, that's the market paying people to move out of the way. If the roll stays calm, that's the market saying stress is contained. And number 3, do we see deliveries stay elevated even in, quote, minor periods, the way we just saw? When quiet months start acting loud, it tells you the preference for physical hasn't cooled. If you track those 3, you'll understand this story faster than the headlines. One last thing before I wrap. There's a temptation to treat this like a movie. One day the vault door swings open, the alarms blare, and everybody panics. Real markets usually don't do that. They grind, they stress, they bend, then sometimes they snap in a moment that looks sudden, even though the pressure was visible for weeks. We are in the pressure is visible phase. So keep your eyes on late February. Watch how March positioning behaves, and pay attention to whether registered keeps bleeding or stabilizes. If registered stabilizes and delivery participation cools, that's a very different story than if both keep trending the wrong way. And if we get a surprise either direction, I'll cover it. All right, that's it for today. Educational only, not advice. I'm not your financial advisor. I don't know your situation, and I'm not telling you to buy or sell anything. Do your own homework. Keep position sizes sane, and don't let the internet bully you into decisions you'll regret.